The most important rule for all the investors: buy high, sell low. Let's start. Hello everyone, Alex is here. You're doing well. Hope you're staying safe. Are you ready to buy some stocks? Because there are some outstanding positions right now on the market that you can add to your portfolio and benefit from the high returns, high dividend yield over the long term. There are a ton of stocks out there. You cannot look at all of them unless you are me.
Nerd.
I'm looking at those all the time. Back to investments. When you're investing your money into stock market, there are some days are good, some weeks are good, some days are bad, some weeks are good, some months are good. You don't know when to invest. You just keep investing all the time. That's what you do. Dollar cost averaging, do not do any predictions and all that. Just keep putting money onto your account. But there is also some calculated risk you can take when looking at stocks. And today we'll walk through the best 3 undervalued stocks today on the stock market that you can add to your positions, which are still a great opportunity for you to invest to. Either add as a new position or add to your current positions for these stocks. All of these stocks are part of the Canadian Dividend Aristocrat list. All of these stocks are paying dividends, increasing dividends all the time. And most importantly, all of these stocks are undervalued right now, and they are a great buying opportunity for all the dividend investors. We will be focusing on 2 main metrics today: price to earnings ratio and historical dividend yield. And I went through all these calculations and how it all works, what is price to earnings ratio, what is the historical dividend yield, and how you can use all of this to determine if the stocks are undervalued right now or not. So you can go check it out, the video there. I'm gonna put the link right here. So click the pause button, then go to that video that I linked above, check it out, then come back here, unpause it, and keep watching this one. And the first one on the list today is Canadian National Resources. The ticker symbol is CNQ.TO. Canadian National Resources is Canada's best-in-class oil and gas stock. This stock is up 22% this year alone. And they also pay a crazy 5% dividend yield as of today, which is great. We're going to be getting a lot of dividends back. And hear me out here that the average dividend yield is actually 3.7%, which means that the stock appears to be a little undervalued, and it means it's a great buying opportunity right now for this stock. First, you'll start benefiting from the high dividend yield right away, and second, you'll benefit from the share price appreciation over the next year or two. The company is still recovering from the market crash of last year, and they haven't fully recovered yet, so it's still undervalued, and it's gonna come back to its pre-market crash levels as soon as end of this year or early next year. So it's a great buying opportunity right now, and I added to my portfolio as well. Canadian National Resources also part of the Dividend Aristocrat list. It means they increased their dividends at least for the last 5 years consecutively, and they've done it for the last 20 years. So you're gonna be benefiting from dividend increases, dividend payments, and share price appreciation over the long term. It is a great stock to add to your portfolio or add to your current positions of this stock until it's fully recovered. Let's take a look at our metrics for Canadian National Resources. The market cap is around $44 billion, so it's a huge company. It's not going anywhere. It's growing over time as well. That's what we want. The current dividend yield is around 5%, which is great. We're going to be getting a lot of dividends, and the average 5-year dividend yield is at 3.73%. So the stock appears to be undervalued as of today. They've been increasing dividends for the last 20 years, so we can expect for them doing that over the long term as well. Price to earnings started to recover as of last earnings report, which is great. The company on that move to come back to its pre-market crash levels. Over the last 10 years, the share price grew by 0%. There's no share price appreciation if you invested into this company 10 years ago. But today, the company is on the lower end, and if you invest today, you're going to be gaining on the share price appreciation over the next year or two. The DRIP amount, the dividend reinvestment plan amount, is around $9,000. So if you want to reinvest back your dividends to this company and get a single share of this company back to your portfolio, you're gonna invest $9,000. You don't have to do it, it's totally optional. I do it myself because I want to automate my dividend reinvestments. I plan to hold these stocks and reinvest all my dividends on the long term to gain from the compound dividend growth. And you can set up your DRIP as well via your brokerage account. I use Questrade, for example, and it's super easy to do it there. I actually went through that in one of my previous videos, so you can check it out there. The beta parameter is at around 2.28, so you can expect the share price fluctuations over the short term. But if you're a long-term investor like I am, don't worry about that. Let's move on to the next one, which is Capital Power. The ticker symbol is CPX.TO. I talked about this company before. It's a great investment, and right now they appear to be super undervalued. Let's check it out why. First of all, Capital Power is an Edmonton-based power generation company that relies on multiple energy sources to produce electricity. So this company is sustainable, it produces things that everyone needs, and everyone's going to be using for a long term for sure. Right now, 20% of the company's earnings are coming from renewable energy sources, 40% coming from the natural gas, and the rest comes from the power plants that use both natural gas and coal. And the company actually set their goals to go off coal by 2023. So it means that the company is going to make our planet better. The company has been slowly growing its revenue and performed actually pretty good in 2020. And Capital Power has been increasing their dividends by 7% annually since 2014, which is great. We're going to be getting a lot of value from these dividend increases over the long term. Today's shares of Capital Power are trading significantly lower than its peers and also offering a high dividend yield as of its current price. And as what to our metrics, the PE ratio, the price to earnings ratio, is well below its peers. It means that this stock appears to be super undervalued as of today, and it's a great buying opportunity. Let's take a look at our metrics for Capital Power. The current market cap is around $4.2 billion. The current dividend yield is around 5.24%, which is great, and the 5-year average dividend yield is around 6.3%. And if you look at this metric, it appears to be that this stock is actually a little overpriced, right? But if you compare this company to the other peers, this actually has more potential than the others. And if you look at the price to earnings ratio for Capital Power, it's actually lower than all of its peers. Capital Power has been increasing their dividends consistently for the last 6 years. So yeah, they're part of the Dividend Aristocrat list, which is great, and they're gonna keep growing their dividends going forward as well. Looking at the share price appreciation, over the last 10 years, the share price grew by 54%, which is pretty good considering this is a dividend stock, so we still are going to be getting a lot of dividends and also benefiting from the share price appreciation over the long-term period. And especially right now is one of the best buying opportunity for this stock, so we can benefit even more from share price appreciation. Looking at the DRIP for Capital Power, it's around $3,100. So it's a pretty easy DRIP to enter, and you're going to be benefiting from getting a single free share of Capital Power every quarter. That's pretty good, and it's going to help out to grow your dividends to get this compound dividend growth over the long term. The beta parameter is 0.74, so we are not expecting a lot of share price volatility over the short-term period. So Capital Power, thanks to its diversified power-producing assets that generate predictable and growing cash flows, we can expect sustainable and consistent dividend growth over the long term and also a share price appreciation over the next year or two. So it's a great stock. It's been a part of my portfolio for a little while, and I also added more to its position as of recently, and it keeps generating me sustainable dividends every single quarter. And the last one for today, it's very exciting, it's a great stock and appears to be super undervalued right now, which is TC Energy. The ticker symbol is TRP.TO. TC Energy has been one of the best dividend paying companies on the TSX. It has increased their dividends for 21 consecutive years, and they also recently announced a 7.4 increase for its dividends for 2021. TC Energy is also super confident that they're going to be increasing their dividends for the next few years as well. I believe that the company's resilient business, growing asset base, multi-billion-dollar secured capital projects and expense management are likely to support their future dividend payouts. TC Energy projects 5 to 7% dividend increases in the next few years. Let's take a look at our metrics for TC Energy. The market cap is around $59 billion, so it's a huge company. They're not going anywhere. They're going to be paying dividends, they're going to be increasing their dividends over the long term. The current dividend yield is around 5.71%, and the 5-year average dividend yield is around 4.5%. So the current dividend yield is higher than the 5-year average dividend yield, which tells us that the share price right now appears to be undervalued, which is great. It's a good buying opportunity. And if you believe in this company, well, I do, we just talked about it, then right now is one of the best times to add to your portfolio or increase your position in TC Energy. And they've also been increasing dividends consistently for the last 21 years. The price to earnings is around 12.8, which appears to be on the lower end if you compare it to its competitors. Over the last 10 years, the share price grew by around 50%, and it means that we still see this sustainable share price appreciation over the long term. And if you're interested in setting up DRIP, dividend reinvestment plan for TC Energy, the amount you would need to invest to is going to be around $4,500. It's actually a pretty easy entrance to DRIP right now, considering the share price they're trading at right now, and also the dividends you're getting back from them. The beta parameter is 0.76, so we're not expecting a lot of price volatility over the short-term period. So overall, if you evenly invest into all these 3 companies, you would be getting dividend yield of 5.3%, which is pretty good if you think about it. And also, these are the companies that you can hold forever. These are the blue chip stocks, the dividend aristocrat companies that has to be in almost every single portfolio. And this is the beauty of dividend investing. You're getting paid regularly for doing nothing. And you don't have to sell anything. Thank you for stopping by. Like this video, subscribe to my channel, click the bell. Let's make this video viral, and I'll see you around. Cheers, bye.